in a funny way, I'm quite relieved. I mean, it was very clear that they were going to take their very large provisions against their existing loan book. And also they're growing their loans dramatically as people are tapping into their sort of revolving credit facilities and using the debt capital markets to raise new investment grade issues. So the huge miss in earnings and earnings expectations for the rest of the year really come through a non-cash item, which is provisions. So provisional losses against future credit losses. And the big question for analysts and portfolio managers is now, well, is that a fair guess? Is that a very conservative guess? Or will they need to do far more over the coming quarters? You know, in the great financial crisis 10 years ago, what we saw was these write-downs came in dribbly stages. They came every single quarter or every single month, and it continued for a year and a half afterwards. They didn't manage to clean out the numbers and the books very quickly. But the new rules in America, the CECL in particular, as well as other issues that the Fed has managed to resolve on capital requirements, has meant, from my perspective as an analyst on these stocks, they are able to do everything they need to now. So I think these are very genuine assumptions of what they think the credit losses will be. And to put them in context, JP Morgan raised its provisions by about $8 billion. But its net income before tax last year was nearly $50 billion. So it's a big hit to quarterly revenues, and it'll be an issue, or quarterly profit. And it would be an issue if it came through over the next couple of quarters. But it is not a meaningful issue for the capital levels of these banks. And I believe that they are sound and very much going to be part of the solution as opposed to part of the problem this time around.
Freddie, you are invested in a number of these big names, which puts some skin in the game. And I want to bring up Goldman Sachs just as a way to look at how you've got so many moving pieces to try and value at this point. I mean, the trading division, the single biggest business for Goldman's, that surged 28% to $5.16 billion. The other side, though, asset management, that fell. You saw a $96 million revenue loss in the quarter compared to a $1.79 billion gain a year earlier. That was where you saw losses on mark-to-market on the debt and equity investments. So you would assume that down the track that we see a drop-off in some of that trading income because we're settling down a little bit on markets in recent weeks. But then on the asset side, does that start to go up because some of the asset prices may recover? You know, how do you value these moving pieces?
Yeah, and that's the great thing about Goldman's as a business, is that these offsetting businesses do move against each other through time and hopefully generate the decent return on equity over a cycle. So their INL, their investment and lending businesses that's sort of buried across the firm, has suffered real mark-to-market losses, which it's not a sort of P&L per se. Again, it's not like dropping in revenues, but it's a very meaningful contributor to revenue to profits, which has been positive in other quarters in the past few years, where trading has actually been suffering. And so it's great to see trading really roaring through this period. And it's not a surprise to see a loss on that mark to market. Goldman's is, out of the major banks, the one who had the largest exposure to these sorts of assets. And I think the market's looking through these to a degree. So, you know, you saw Goldman Sachs huge miss on earnings versus expectations from a month ago. But the stock was actually trading up yesterday in a pretty aggressively down market. And I think that's just a sign that's emblematic of what people are having to come to terms with in order to invest at all in this stock market, which is the next 3, 6, 12 months maybe are going to be very, very difficult economically and from a bottom-up perspective for these businesses. However, if you look through and you believe your business has the capital and liquidity and the strategy to survive and maybe thrive the other side, you can start looking through maybe 18 months ahead.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.